Hi, welcome to Main Street Macro. I'm Neela Richardson. Do you know that there are some songs that really just capture the moment? And especially if you're looking at some cards in your hand, that Kenny Rogers classic may come to mind. Remember the lyrics? Now, I'm not going to sing them to you. I wouldn't do that to you. Just say them along with me if you remember. It's you got to know when to hold them, know when to fold them, know when to walk away, and know when to run. That song, I think, perfectly captures the week events in economics because the Federal Reserve will be meeting once again in Washington, D.C. to decide whether or not to raise interest rates yet again. And this is all going to depend on three different scenarios, depending on what the Fed thinks about the cards it's been dealt. So let's take these three scenarios one by one. The first is whether to hold them. So you see, the Fed has been raising interest rates pretty steadily for the past year. It's hiked 10 times. It took a pause last month. But if it hikes again this week, it'll be the highest interest rate level in over 20 years. So, does the Fed keep the hands it has, keep raising interest rates? Well, that'll be dependent on what it sees in terms of one, the labor market, which is still solid. We're seeing the unemployment rate still near record lows. And the question is, will the labor market continue to be solid even if interest rates go higher? Now, the second option that the Fed has as it looks at the cards in its hand is to fold. You see, one of the things that a good player knows when playing cards is when to quit and back away. And here, there may be a reason for the Fed to just stay at the 5% benchmark level that it's achieved thus far and not to push the economy any further along in this interest rate path. The reason being is that we got some good news really recently in terms of inflation. It's now 3% over the last 12 months, and that's the lowest it's been since March 2021. Now, there is still some reason to be concerned that service inflation, especially those services that are consumer facing, tied to shelter costs, that have a lot of labor input, are still seeing high inflation, and that inflation could tick up again in coming months. So, if the Fed quits its rate path too quickly, it risks actually stoking inflation yet again. Now, there's one more option on the table for the Fed, and that's just to walk away, which in this scenario means cutting rates. And why would they cut rates? Very low probability this month. But if the Fed sees in the hands that it's been dealt an outlook for recession, that the economy will actually take a downturn in the second half of the year, it may make them rethink holding or folding. It may have to take a decisive action and cut those rates. Now, economists are pretty split on whether we'll see a soft landing or even a mild recession that's short and quick, but the Fed has to keep its eye on the economy as it's trying to tackle inflation. Now, the Fed will find out soon enough what it plans to do with the cards it's been dealt. But I'll tell you one thing, a winning hand for Main Street is a hand in which inflation continues to moderate and the economy continues to grow. Thanks for watching the Main Street Macro. For more information on the week ahead, please check out adpri.org.